Welcome back and thanks for being with us. 1.6% low on the Nifty 50 index as we speak. That's where we've kind of stabilized. But really the recovery in the Nifty mid-cap and small-cap indices is what's really standing out on a day like this. Let's pull up the Nifty mid-cap and small-cap indices. From the day's low, we've seen a very decent recovery. We're now just around on the Nifty mid-cap, please. If we can pull that one up, you'll see the kind of recovery that we're seeing. But anyway, so that's on the Nifty mid-cap and small-cap indices. We've seen a decent recovery. Case in point, 2.5% lower on the Nifty mid-cap and small-cap is what we were seeing at the start of the day. But now we're seeing a very, very decent recovery. If you can please pull up the Nifty mid-cap as well as small-cap indices, that will help contextualizing what I'm saying. In terms of the Nifty 500 index, again, the advance decline ratio is completely skewed, just about 70 advances to nearly 430 plus declines is what we're seeing on the Nifty 500 index. Zydus Wellness there continues to be in focus, 9% higher on that counter, 7% higher on Tata Chemicals. Not seen a move like that on Tata Chemicals in a while. Tata Investment, NTPC Green, Acme Solar are just some of the other movers. Triggers, of course, for Acme Solar, but outside of that, really the triggers are far and few. But nonetheless, you're seeing a very, very decent move on some of those names. In terms of the big losers, 14% lower on Jyoti CNC. Ola is the other big loser. Cohance 5% lower as well. But let me switch focus. ET Now exclusive. We've learned from our sources that the government is planning to incentivize CGD companies for pipeline infra by launching a 5,000 to 6,000 crore scheme. Prakash Priyadarshi joins in with more details.
Well, in view of the West Asia crisis, wherein we are facing supply disruptions of petroleum products, in fact, the government is working out, making all out effort to ensure sufficient availability of petroleum products in the domestic market. Now, sources are indicating that the Oil Ministry is working on a plan to provide incentives for compressed biogas production. In fact, incentives will also be provided to city gas distribution companies to connect compressed biogas plant to city gas distribution network. Sources indicate that the interministerial consultation has been initiated wherein the Oil Ministry is discussing this proposal with ministries such as MNRA, coal, power and fertilizer. In fact, as per the initial plan, the Oil Ministry will be providing 50% incentives for connecting compressed biogas plant to city gas distribution network. So these incentives will be provided to city gas distribution companies to cover their overall cost on setting up of pipelines to connect CBG to city gas distribution network. A very significant development coming in. In fact, you are aware about the fact that the government is also moving ahead with the objective to blend at least 5% compressed biogas with natural gas, and therefore government will now provide incentives to city gas distribution companies for setting up of, in fact, connecting CBG with the CBG plant with city gas distribution network. Interministerial consultation is underway, and sources suggest that the draft rules will be announced very soon, and the government and the Oil Ministry will approach Union Cabinet for final approval. Back to you.
Right, Prakash, thanks for that. In fact, let's pick up on all these points and a lot more. We've got M.K. Sirana, the former CMD at HPCL, joining in on the show right now. Mr. Sirana, great to have you on ET Now once again. Firstly, on the latest news piece on the hike in export duty on diesel and ATF, how do you read this latest development?
Good morning, and thanks for having me on your show. If you see the trajectory of this taxation in the past, the government has always tried to ensure that the consumer prices are not changed, and the shortfall in the recovery from the oil marketing companies made up either through variation in taxation or through windfall tax or through export duty. Now, that is one aspect. The second aspect is that it has been observed that when the international prices are high and the domestic prices are very subsidized, then some of the private players stop selling in India and they start exporting. that volume shifts to the PSU oil marketing companies and they suffer more loss on that. And therefore, it is logical that when the international cracks are so high on diesel and ATF and the domestic prices are still maintained the way it is since last almost 3-4 years, so it is logical that the government will try to take out a part of it to ensure that there are no windfall gains by some of the companies at the cost of some other companies.
Okay. And with regard to Reliance in particular, Mr. Surana, what's the kind of impact there? Because windfall tax will not be applicable on Reliance's export refinery. And this is almost nearly half of its total refining capacity. Are we understanding this right? I'm trying to get a sense.
I think that is what is understanding, that probably the export refinery, SEZ refinery, this will not be applicable because that was meant for export only. So it will be applicable only to DTA refinery, and out of the DT refinery, the part of the quantity they sell in India and part of the quantity they were exporting. And I think the export duty will be applicable on the DTA part of the exports.
And with regard to, the latest, which I'm not sure if you had a chance to listen to my colleague Prakash, he was speaking about CGD companies and the government in terms of the pipeline infra by launching around 5,000 to 6,000 crore rupee scheme. That's what he was speaking about. Do you believe that that will translate in your opinion or not really?
No, the way the situation is at the growing trajectories there, we need to find out more and more indigenous sources of energy. And otherwise, the threat will always remain for a country like India where the demand is growing and we don't have our own sources of oil and gas to that extent. And to that extent, government has been working on various fronts, which include the biofuels, ethanol, biogas, gobar gas, and other form of energy, wind, solar, etc. And government in the past has given certain incentives to promote this type of sources. And I think I have not heard what Prakash said, but I'm sure that the government will be planning to incentivize this sector. And there is also a plan to have some minimum percentage of CBG dosed into the natural gas system so that we have the reduction to the extent possible on the imported fuels. And there is, to that extent, for setting up the plants, there will be an incentive, and that is logical.
Right. Mr. Surana, Prakash was flagging off, and he's only picking it up from his sources right now, that there could be a 5,000 to 6,000 crore rupee government scheme to try and incentivize CGD companies for pipeline infrastructure. What I wanted to talk about was, what is it that you make of the pace of the last mile connectivity when it comes to India? And is the pipeline rollout generally sort of lagging behind the CGD licenses? And would you say that perhaps capital infusion is the possible answer?
So if you see, as far as the licensing is concerned, in last 4 or 5 years, a substantial part of India has been covered by that. Now, to actual implementation on the ground, there are a few issues in terms of right of way. Some places the pipelines to pass through the congested area, so you don't get the permits to dig on the roads. And the second part is the adoption of it. Many of the times, even if the pipelines are laid, the network is available right up to the door. People are still continuing with the LPG connection which they have because they are used to it. Then also because the CNG becomes more profitable, the PNG part takes slightly a backseat. Now, government had been incentivizing from time to time to push the CGD companies to push for PNG connections. And in the recently also government has tried to put that the people who have got the pipeline network available, they should try to shift to PNG and give up the LPG cylinders. And the CGD companies are also making a campaign to that extent by waiving of the connection charges of the initial deposits, etc. Now, at the same time, government has also requested the state governments to push for and give the approvals, and even they have tried to incentivize them by giving additional quota of commercial LPG to promote that the pipeline connectivity is provided, and wherever the pipeline is connectivity is there, the adoption is there in the societies and in the areas. And at the same time, state government also push it when they've got an incentive to get additional quota of commercial LPG. So I think government is trying on this issue, and the everyday briefing by the government, which happens on the West Asia thing, they had been stating also the number of additional connection, which has been given. The last I heard was there are around 362,000 additional pipeline connections were given. So, and now the second part is, even when the consumers will feel that the PNG is easy to get, you need not worry about when the cylinder is coming, I think the adoption will also increase. So everybody has to try it out. The government is also trying by various means, by incentivizing, by easing out delaying of the pipelines, by incentivizing the customers to take. So we have to try all the things.
Mr. Surana, how would you assess India's response to the current situation? We've seen a very small fraction of crude actually come through the Strait of Hormuz versus what was the case at the start or at the end of February. Your assessment of how India has responded to this situation, how insulated are we, and for how long, if at all, this were to continue, can India remain to a large extent insulated?
No, if we see, government of India has taken a lot of action, and I would say that they have navigated it very well so far. No, there is no denial that there is a problem when a substantial part of the resource which is available from particular area get blocked. But by diversifying the resources, let's say from Russia, from America, from Australia, so far, and even by the back-end diplomacy to get some of our ships which were there in the Strait of Hormuz also getting clear. I think 7 or 8 ships have come so far of crude and LPG from the Strait of Hormuz as well, and from the other sources. Russian source of energy had been a good thing to have happened, because that has insulated us to some extent. Now, so it is an evolving situation, and day to day we need to find out our own ways of dealing with the situation. But I would suppose that so far we are navigated it well. At least in India, the consumers are not affected so far. We are getting our LPG, we are getting our petrol and diesel. The prices are unchanged. When we compare it to the other countries, our neighborhood, where the prices have gone up 2 to 3 times, there are problems. Now, of course, the government also had to take some actions like reprioritizing LPG and LNG to domestic sector compared to industrial sector. But gradually they have relaxed that also. And at the same time, like increasing the time between the two cylinder booking. So those measures will be required, and from time to time we have to respond. But I would say that government of India has responded very well so far, and they are constantly trying to do that. Also, like you would have seen that some of the senior diplomats and the ministers are making a visit to the different countries to have our position and understanding and how to we navigate further. The solution lies in diversifying our sources and diversifying the origin of the sources. And to that extent, just imagine, had we not gone so much impetus on wind and solar and the renewables, or let's say biofuel of ethanol blending for 20% or the biogas, our problem would have been more. So some of these actions have fructified to that extent.
Right. Mr. Surana, lastly, I want to talk about OMCs because they continue to face under recoveries. Basis your judgment and, experience, and of course, interactions with the industry, which I'm sure you must be making on a regular basis. What is the quantum A, and how will the roadmap of these recovering the losses look like?
See, as far as under recovery is concerned, ministry themselves have put up the figures. So I would not like to comment further on that, but I can only say that these under recoveries will differ from company to company, because what is being said is the daily price of the product versus what is the domestic price. But actual under recovery will be a factor, will be on the integrated margin. So depending on what the percentage of refining and marketing and how much they make on the refinery side and how much they make on the marketing side. But definitely there is no problem. There is a huge under recovery currently. Now, because the 10 rupees reduction in the excise duty would have helped to some extent, but definitely the under recovery is much more than that currently. Now, in the past, we have the oil industry has navigated through this type of situation when to some part of things they have absorbed for some time, and the time corrections happened subsequently when the prices came down. But there is a limit to what extent you can do, because it cannot continue for a long time, and it will depend on the trajectory of the war and how long the prices remain high. And because there is another issue of the exchange rate also. Currently, the exchange rate is also running high. So $1 increase in the crude is one part of it, but the 1 rupee increase on a dollar almost has the same effect. And therefore, we need to be conscious of both. The third part is the liquidity part, because it is a high volume business, high rollover of money is required. If you are constantly under recovering from the market compared to what you are paying for your raw material, of course, there will be some credit terms, but it may affect the working capital management. So all the three have to be taken care of. And I think at some point of time, further call will be required on taxation or the pricing if it goes longer. And but we need to see as the situation adopts, because the prices will have some effect on the macroeconomics, some effect on the inflation. So I would see that probably the situation is slightly challenging for the oil marketing companies as far as the under recoveries are concerned, and probably government will need to see what is required.
Indeed, wait and watch mode as always, and of course a very, very fluid situation at hand. Mr. Surana, thank you as always for your time.
Thank you so much. Thanks for having me.
Okay, still looking weak. While we've covered some amount of, the lost ground from where we opened up in trade, but not quite out of the woods. Some of the Adani group of names, some of the power names are the ones which are actually lifting up. But the major chunk of the market still in the red, and 380 points lower, no less, on the Nifty future still, and a very weak market breadth as well at our hand. But we'll wind it up right here on this edition of The Market. Thanks for watching. All that is happening within the broader end of the market, and not just highlight the counters that are buzzing or rather weak in this particular market. But yes, of course, there are a lot of these counters that are still managing to hold up well, and we'll discuss all of that in detail and also get the big voices and connect with the managements. But before that, let's take a look at the key headlines that we are tracking at this hour. First up, Jyoti CNC is under immense pressure when French authorities are investigating Jyoti CNC automation subsidiary for alleged violations of EU export control laws involving dual-use technology machinery. The investigation has resulted in significant interim measures, including seizure of 4 million euros in bank accounts, restrictions of Director General's duties, and attachment of 2 residential properties. Well, on the flip side, Enviro Infra Engineers is soaring in trade after receiving letters of empanelment for 2 sewage infrastructure projects in Maharashtra, valued at a combined total of 972 crore rupees under the Swachh Bharat Mission Urban 2.0. The projects are located in Pune and Nashik. Solar is doing well in trade. HSBC Global Investments Research has initiated coverage on Acme Solar Holdings with a buy rating and a target price of 350 rupees. The brokerage sees a renewable energy sector reaching another inflection point, citing cost advantages, strong policy support, and rising power demand. EV players like Ather, Electra Greentech, JBM Auto among others are gaining in trade after the government unveiled a new draft EV policy to accelerate adoption. The draft policy suggests only electric 3-wheelers to be allowed for new registrations from 2027, following by a shift to electronic 2-wheelers from 2028. And Swiggy is slipping in trade after co-founder Lakshmi Nandan Reddy resigned from the company's board with effect from April 10 to pursue other professional interests. And yes, of course, onto the Midcap Masala show, it's time to connect with our first management onto the show, and let me get in conversation with the management of CMEC Limited. Lots been happening there. Let's understand that what's the visibility going ahead, because yes, of course, their key clientele includes ONGC, and we also know that the company plays a very important role in a sector which is at the helm of having an experience with respect to the West Asia war and getting impacted. So what's the on-ground situation? Let's understand all of that in detail. We are being joined by Mr. Sunil Gupta, who is the VP Strategy of CMEC Limited, joining us on the show. Hi, very good morning, Mr. Gupta, and thank you so much for your time. And let me start with the latest developments that have come out to be a bit of a mixed operational update with CMEC Diamond resuming its ONGC contract, while Agastya is temporarily off hire. Give us some understanding. How should we interpret this in terms of the near-term utilization as well as any revenue impact?
Near-term utilization is good because the market conditions are very buoyant. India has to be self-reliant in energy, and I'm sure this will improve the oil activities in India. Diamond has gone to a dry dock, which is a mandatory thing every 2.5 years for every vessel. It has completed its dry dock in about 60 days and has incurred about 4 to 5 crores of OPEX, which will be amortized over 2.5 years.
Okay, understood. Mr. Gupta, morning. This is Nehi also joining in. You've also recently won, morning sir, you also won nearly 740 crore rupees worth of O&M contracts for Samudra Prabha and Samudra Sevak. How significantly do these wins strengthen your revenue visibility and, let's say, margin outlook over the next 2 to 3 years?
Both the contracts are O&M contracts, which means there is no capex outlay, and hence the margins will be good, as well as these will contribute to a higher ROC for the company. And definitely strong cash flows will mean that we are rightly positioned to do any growth capex which the country may need for the improved activities.
All right. That's good to hear. But along with that, Mr. Gupta, you have indicated that Q4 revenue and profitability could moderate. Now that you are saying that near-term utilization is expected to be good, should we attribute this, your earlier comments, to maybe dry docking, or there are any other underlying pressures on the cost or the charter rates as well?
We have just concluded Q4 and our results are next month. So I would not like to say anything on Q4 right now. Maybe your viewers can see it in a month's time. But yes, the moderation that we did was precisely for two things which were abnormal last quarter. If everything goes well and we will be out next month, early next month with the numbers, you will get to see how we have performed.
Okay. And Mr. Gupta, on charter rates, you've guided for stability. For how long do you expect this phase to continue? When do you see a meaningful upcycle kicking in given improving your offshore activity?
See, our charter rates are of two categories. One, spot contracts, and other long-term contracts. In long-term contracts, the rates are locked in till the expiry of contract, and any upside will happen only on the renewal of the contract. In terms of spot contracts, yes, we believe that they should do well in the coming period, which is for CMAC 3 and CMAC Princess.
All right. That's about the charter rates. But along with that, Mr. Gupta, given your exposure to the global markets and the clients like ONGC and some of the Middle East players, how are the evolving geopolitical tensions in the West Asia impacting demand, pricing, or there could be some execution risk in the business as well, if you wish to highlight?
Sure, sure. See, in a previous such interaction, we had mentioned that one of our vessel, CMAC Paladin, is in Dubai for a dry dock. And because of this war, we are not pulling it out to ensure its safety. Second, one of the vessel is in Saudi Aramco, deployed, functioning well, and at this moment, giving good revenues and profitability. We believe once the situation normalizes, India should work towards energy sustainability and energy sufficiency, which will improve activities and should be, I think, next 4 or 5 years should be very good for oil companies and energy companies per se.
Okay, and let's talk about the other big business update, Mr. Gupta. With the Anand acquisition underway, how are you thinking about capital allocation while maintaining a comfortable balance sheet, and what kind of return thresholds are you targeting with this?
Our net debt is 0, and with the current performances, we believe that we should not step out of 1.5:1 debt equity and 3:1 debt EBITDA. This will give us enough room for acquiring Anand, as well as any other growth capex that the company may be able to do.
All right. And lastly, Mr. Gupta, with exploration demand picking up, what does your order pipeline look like from your key clients, ONGC, as well as some of the international players as well? How confident are you about sustaining the growth beyond FY27? And initially, has there been any uptick of sorts in terms of getting more orders or inquiries on this front?
Definitely, there are inquiries, and at present, all our vessels are fully utilized. And that's the reason we will be adding Anand next year, which is current year 27. And soon we'll see any possibilities of growth acquisition, which can fuel the growth for the 28-29 as well.
Okay, on that note, Mr. Gupta, it's been a pleasure interacting with you. Thank you so much for your time, and good luck for the new financial year.
Thank you.
Thanks so much. Okay, viewers, on that note, time to slip into a very short break on this edition of Midcap Masala. On the other side, we have a very interesting conversation lined up with the management of Suryodaya Bank. So stay tuned with us and we'll be right back.
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी.
This were to happen. And of course, to talk about a lot of other business updates as well, let's welcome on board Mr. R. Bhaskar Babu, the MD and CEO of Suryodaya Small Finance Bank. Mr. Bhaskar, morning and thanks so much for your time. You know, now with this RBI proposing inclusion of quarterly profits in CRAR, how much capital headroom does this unlock for growth for your bank going ahead? And also give us a picture on CASA. It improved to 22.5%, but still trails your larger peers. What is the aspiration there? How is this provision, if passed, going to aid that?
It will certainly help in terms of including the quarterly profits in terms of calculating capital adequacy. Instead of waiting for not only the year end, we'll have to wait till the audited financials come out and only then you can add it. Earlier we were excluded, now we have been included, and also the clause of provisioning should not be varying beyond 25% has been eased. That's, I think, is a very good one, because in an increasing scenario also the provisioning will come down. Will there be a change beyond 25%, at least for good? So this will really help us in terms of adding quarterly basis, marginal but very positive. And as far as our CASA is concerned, we're really focusing back in terms of what is truly a granular, sticky deposits to be in savings account or current accounts. It should not necessarily be the bulk money sitting on it at a high cost. A flow should lead to float, which is the classic CASA. So we have started focusing on it. Glad that it is inching up by 150 basis points year on year. The intent is to, can we have the CASA, which is truly low cost, sticky, happening out of the flow happening in the transaction, in the account.
All right. Good to know about it. Morning, Mr. Bhaskar. This is Shrishti also joining in. But what is the normalized credit cost for FY27? And what are the key assumptions there in terms of slippages, recoveries, write-offs that you might need to achieve this?
27 looks good in terms of both growth as well as in terms of credit cost substantially will come down. But however, it all hinges now on the situation which is going on. So hopefully, if things don't really worsen and they stabilize, likely the credit costs overall for at least the SMB sector, which are predominantly at least have 40 to 50% microfinance, will be kind of easing out by 25 to 50% compared to last year. Last year was a very challenging year. As we enter FY27, it looks both good or both on in terms of the credit cost mitigation as well as in terms of our growth itself looking pretty strong across the sector. Specifically for us, we are targeting around 25 to 35% growth in terms of assets, in terms of deposits, and hopefully on the profitability as well.
That sounds really optimistic, 25 to 30% growth you're targeting across key metrics. But I have been looking at some other numbers too, Mr. Bhaskar. Your cost to income ratio is still around 75%. If you could help us understand what are some levers at play right now or some plan of action that you're deploying to try and bring this below 65%, when can we realistically expect this?
This includes the insurance costs which pay on the credit guarantee fund. We chose in the good time at FY23 that since this is cyclical at once in 4 years, once in 5 years, but rather we truly consider as an insurance that if you don't make a claim, the portfolio quality is very good. But in case of one swing in kind of years, which is unpredictable, we want to protect. That kind of contributes to around 8 to 10% of our overall cost. Minus that, we are still currently reasonably good at 65. The intent is to calculate the cost to income minus the credit guarantee fee which we pay on a year-on-year basis. Currently, most of 98% of our 50% portfolio, which is in inclusive finance, is covered by CGFMU. And that comes to around approximately 1% of the portfolio, 1.5% in terms of credit cost. If we calculate that in the OPEX, minus that, we are currently at around 60%.
All right. But along with that, Mr. Bhaskar, despite strong loan growth, your profitability seems to be lacking. What are the key drivers that are required to move your ROA from 0.9% to the guided 1.2 to 1.5% range?
Mainly credit costs. So last year we had to provide for quite a bit in terms of credit costs because of the mini crisis in the microfinance segment, which has not eased out. And more importantly than that, we kind of wanted to protect ourselves, ring fence in terms of cyclicality. We moved into not only individual loans to the inclusive finance customer, we kind of now started doing appraisal in terms of individuals. It is a little expensive, not time consuming, that now it's happening through digital mode. So hopefully with this would really contribute more than PPOP has been steady. But beyond PPOP, the credit cost is what really dented our return on assets and hence consequently the return on equity, both of which should improve as we see last quarter and hopefully as we guided in this quarter. The previous quarter went by and FY27 looks far more robust in terms of substantially reduced credit costs.
Okay, so that looks good. And on the back of that, Mr. Bhaskar, your NIM guidance of 7.5 to 8%, are you maintaining that? Are we looking at any revision over there?
That is intact. Around 6% of our book is non-earning. So that will kind of ease out once we make our claim under CGFMU and provide for it and write off as required. Suppose that even today, minus that, it's comfortable at around 8.5%. We intend to maintain it. It's not going to be substantially higher, but it will be consistent and moving up by 25-50 basis points for at least the next couple of years.
Okay. And Mr. Bhaskar, in your commentary for next year, you've also said digital businesses like credit on UPI, digital deposits, they're expected to scale and support growth. What part of the business mix is this going to be? And also credit on UPI as a section is also scaling rapidly. What are the early delinquency trends that you're seeing here compared to the traditional MFI playbook?
Currently, the credit on UPI, which CLOU, what we do is that it's almost like a charge card. The entire money had to be paid on the due date. So whatever is a fee income that we make out of it, minus the payment which is not coming even for 3 months, it's still on the positive range. It's a beautiful, good engine in terms of acquiring large number of customers. As we keep saying, it's going to be really democratizing credit. We can acquire customers who are giving a credit as low as even 100 rupees. Currently, our average is around 5,000. We have 1 million customers who are approved, and around half of them have taken the sanction, and around 3 lakh customers have utilized it. So it's kind of doubling on a smaller base month on month. watching it. And since these are people who have earlier utilized and have good track record, have proved in the last 1.5 years and a good credit score, we do really expect on the month-on-month basis, it's likely to be around closer to 2 to 2.5% max. As of now, we are seeing much lesser, but that's a playbook is in terms of looking at maybe 2% of the overall disbursements on a monthly basis may go as a bad debt, but the 98% who pay will continue to be profitable because they're utilizing it on month. On the digital deposits, we have seemed to have done a good job. Currently, around 40% of our incremental fixed term deposits are coming through digital mode, which is average of around 1.5 lakhs, completely granular. So that's what really excites us. We would like continue to do that and focus on this digital deposits. We are currently at around to just cross 2,000 crores in terms of completely granular 1.5 lakh depositors, approximately around 1.25 lakhs of deposit per customer. Likely that this will double in this current year of FY27.
That sounds good. Mr. Bhaskar, talk to us about asset quality. The number that we saw, at least towards the end of Q3, is slightly away from the guidance that you had given for overall FY26. If I'm not wrong, you've guided for roughly 3% NNPA. That number has come at roughly 4.3%, at least till Q3 end. If you could just help us understand what is the roadmap to reaching this 3% number on your net NPA?
The slippages had been high in the first quarter. So, however, ours, as I said, is completely covered under CGFMU, likely to make a claim and we'll get it in Q1. And once we kind of get it set off against the cross NPA, till we make a claim, it continues to be in our book and hence looks elevated. Post that, it's likely to be substantially lower and closer to the guidance which we've given.
Okay, and lastly, Mr. Bhaskar, before we let you go, I'm just trying to understand, the ROA that you had guided for last year, that was then moderated slightly lower. It was revised to 1.2%, and as of now, it stands slightly lower than that. Any visibility on how far 1.2% is from here?
We are kind of now improving quarter on quarter. I won't really talk about the specific numbers of Q4 as the results are kind of not yet out. So, but the fact is that, as we kind of mentioned in all our guidances, is that every quarter has been looking good. Exactly the last year, every quarter was looking kind of bad. So in the last 2 quarters, it has been looking good. So if we continue to maintain it, we will at least have an exit run rate which is closer to the guidance, and we'll have to kind of improvise on it during FY27.
All right, and we look forward to that. With this, Mr. Bhaskar, we let you go. So good having you on the channel today. Thank you so much for your time.
Thank you much.
All right, but with this, viewers, let's move on and let's get you an ET Now exclusive then. And we have learned from our sources that the government is planning to incentivize city gas distribution companies for pipeline infra by launching a 5,000 to 6,000 crore scheme. Let me take it across to my colleague Prakash Priyadarshi, who joins in with more details. Prakash.
Well, in view of the West Asia crisis, wherein we are facing supply disruptions of petroleum products, in fact, the government is working out, making all out effort to ensure sufficient availability of petroleum products in the domestic market. Now, sources are indicating that the Oil Ministry is working on a plan to provide incentives for compressed biogas production. In fact, incentives will also be provided to city gas distribution companies to connect compressed biogas plant to city gas distribution network. Sources indicate that the interministerial consultation has been initiated, wherein the Oil Ministry is discussing this proposal with ministries such as MNRA, coal, power, and fertilizer. In fact, as per the initial plan, the Oil Ministry will be providing 50% incentives for connecting compressed biogas plant to city gas distribution network. So these incentives will be provided to city gas distribution companies to cover their overall cost on setting up of pipelines to connect CBG to city gas distribution network. A very significant development coming in. In fact, you are aware about the fact that the government is also moving ahead with the objective to blend at least 5% compressed biogas with natural gas, and therefore government will now provide incentives to city gas distribution companies for setting up of, in fact, connecting CBG with the CBG network, CBG plant with city gas distribution network. Interministerial consultation is underway, and sources suggest that the draft rules will be announced very soon, and the government and the Oil Ministry will approach Union Cabinet for final approval. Back to you.
Okay, Prakash, thanks so much for taking us through that. So yes, that's an exclusive coming in on the entire city gas distribution space. But on that note, I'm worried we're completely timed out on this edition of Midcap Masala. From Shrishti, me and the team that put this show together. Thanks so much for tuning in, but stay on because Buy Now Sell Now is up next.
केसरिया